Today, when the markets open, your screen will look normal. No breaking news, no emergency press conference. But inside the banking system, a single line of fine print changes. From that moment, it becomes more expensive for banks to live on paper metal and more attractive to sit on real bullion. On paper, it looks like a minor tweak. In reality, it is the start of a slow, silent wealth transfer. It makes it cheaper and safer for big institutions to hold the collateral the rulebook now blesses as safe. And it leaves everyone else packed into promises that are easier to inflate or quietly push to the back of the queue in a crisis. On a chart that looks like nothing. On a balance sheet, it starts to decide who sits on assets. The system will fight to protect, and who is left holding claims that only matter while everything works. If you save in cash, in low-yielding bonds, or in paper claims on metal, this is not a footnote. It is one of the ways the system can reset without ever saying the word default, simply by changing what counts as safe and what counts as expendable. For years, the public has watched the wrong thing. We stare at gold and silver prices flickering up and down. Meanwhile, the real decisions have been made in small rooms in Basel at the Bank for International Settlements, where regulators wrote Basel III, the post-2008 rulebook for how banks fund themselves and what they are allowed to treat as solid collateral. On paper, Basel III is about making banks safer. In practice, its final phase rewrites what counts as stable funding and how costly it is to run big, leveraged positions in gold and silver, and it draws a line inside the metal market between forms the rulebook treats as hard collateral and forms it treats as a fragile promise. And that leads to a simple, uncomfortable question that runs straight through your savings. When the rules reward physical and punish paper, who ends up holding the metal and who ends up holding the bag? To see why this matters, you need a clear picture of how bullion banking actually works. For decades, the heart of the global gold and silver trade has been unallocated accounts, especially in London. On a statement, an unallocated account looks like metal, 100 ounces of gold, 10,000 ounces of silver. In reality, it is a claim on a bank, not a specific bar with your name on it. Behind the scenes, the same bar can sit at the center of a web of leases, swaps, and forwards. Critics compare it to a fractional reserve system for bullion, many layers of claims stacked on a limited pile of metal. That structure makes trading cheap and liquid, but it also means that in a real crisis, not every claim can turn into delivery at the same time. Allocated bullion is the opposite. Allocated means specific bars with serial numbers sitting in a vault for one owner. The bank does not lend those bars out. There's no chain of paper IOUs built on top of them. For years, regulators treated these two worlds, the IOU and the bar, as almost interchangeable when they calculated bank capital. Basel III starts to separate them. One of the quiet tools inside Basel III is something most savers have never heard of, the net stable funding ratio, or an SFR. In plain language, it pushes banks to back hard to sell assets with more reliable funding. If a bank holds something that might be difficult to dump in a crisis, it is meant to fund it with money that will not disappear overnight. Under this rule, many precious metals positions, especially unallocated in trading books, are given a very heavy funding charge. In Europe and in the United Kingdom, for example, regulators set that charge at about 85% for a wide range of precious metals activity. In normal language, that means this: for every $100 of certain gold or silver positions, a bank may need roughly $85 of steadier funding behind it, not just a thin layer of overnight money. Cheap short-term borrowing is no longer enough to support very large, complex bullion books. The rule does not ban paper metal, but it makes very big, lightly funded, unallocated positions much less attractive than they used to be. Here is where the incentives flip. Banks can still hold bullion on their balance sheet. But under the Basel framework, fully allocated, physically held gold is treated much more kindly than a stack of unallocated claims. In many places, properly allocated, gold carries a very low and, in some cases, effectively zero risk weight in a bank's capital calculations. In some liquidity tests, it can be counted more like cash or high-grade government bonds than like a risky trading position. Unallocated positions, by contrast, tie up more of that scarce, stable funding under NSFR and related rules. So from a bank's point of view, the choice starts to look simple. Hold real allocated metal and use it as high-quality collateral, or hold synthetic and unallocated exposures and burn more of the balance sheet to support them. As these rules filter through different regions, the old game of squeezing big profits out of huge, cheap paper positions becomes steadily less appealing. Officially, the goal is safety. In practice, the rulebook quietly steers banks toward hard collateral and away from the most leveraged promises. Not everyone is standing in the same place when those new incentives bite. Basel III quietly favors players that already sit on real metal. Central banks that have spent years adding to their gold reserves, especially in emerging markets, now find that asset lining up neatly with the modern rulebook. Sovereign funds in Asia and the Middle East that treated gold as a neutral reserve are in a similar position. Big bullion banks that shift toward fully allocated metal can drop it into their balance sheets as strong collateral instead of a risky trading bet. Others are more exposed. Smaller industrial users that depend on cheap and predictable silver finance feel every rise in funding cost and every extra flicker of price volatility. Clients who sit in unallocated or pooled metal products at banks are now part of positions that are more expensive for those banks to fund. The text of the rules never says these people win and these people lose. But once you change what is rewarded and what is treated as costly, that is what you create. In London, the bullion market could see the direction of travel early. When funding charges like the new stable funding requirement were first discussed for precious metals, the London Bullion Market Association and other groups warned that this could make the traditional clearing system more expensive and might push some banks to cut back or reshape their books. They argued that it could mean less liquidity, wider spreads, and a harder job for miners and industrial users who need to hedge. Regulators heard those arguments, adjusted some details, and then pressed on. A few years later, official European reviews would say the change had only a limited impact and that banks adjusted well before the final dates. That contrast between loud concern in the market and calm language in official reports matters. The numbers on the page say the shock was absorbed. In practice, the response was a slow shuffle into positions that were easier to fund under the new rules and away from the thinnest, most leveraged, unallocated books. Silver sits in an even stranger place. Under the Basel framework, it is treated much more like a regular commodity than like a monetary reserve. Banks that finance large silver positions for factories or trading desks face the same kind of heavy long-term funding charge on many of those exposures. The old model, where a bank could earn a spread by taking short-term deposits from clients and turning them into longer-dated silver loans, still exists but makes less money once you add the extra regulatory cost. For industrial users in electronics, solar panels, and batteries, that raises an awkward question. If banks decide that running large paper-based silver books is not worth the effort, who will stand between the mines and the factories? And what happens to price stability if more of the trade has to be backed by cash and real metal instead of layers of cheap credit? Even if everything works smoothly on the official measures, the system has less cushion. Silver prices become more sensitive to real supply and demand and less cushioned by a thick layer of leveraged paper trades. Now zoom out. All of this is happening in a world where government debts are huge and the interest bill keeps rising. Basel III is not a return to a gold standard, and it does not order banks to buy bullion. What it does, in that setting, is push the system towards stronger backing for its promises. There are really only two broad ways to do that. You can make banks hold more capital and more stable funding, or you can improve the quality of the assets they hold. Allocated bullion is one of the few things that can sit next to cash and top-grade government debt as a store of value that is nobody else's IOU. That is why some analysts talk about a quiet remonetizing of gold, not as money you spend in shops, but as premium collateral in a system that is short on trust. Seen that way, Basel III is less about scolding speculators and more about giving an edge to institutions that already hold assets that can ride out stress. This becomes even clearer when you look at derivatives. The global web of over-the-counter contracts, interest rate swaps, currency deals, and commodity futures adds up to tens of trillions of dollars on paper, and all of it sits on top of collateral and funding. When the rules say that more of those trading books must be backed with steadier money, the cost of offering cheap leverage to hedge funds and trading desks goes up. That does not mean an instant crash, but it does nudge the system toward using less borrowed money and demanding better collateral. Some people see that as naturally friendly to gold and maybe silver, because if there are fewer thin paper claims and more contracts tied to real metal, prices have to sit closer to the point where real buyers and sellers meet. Others point to early European experience and say the effect has been modest so far. The truth is, likely somewhere in between, less extreme leverage, more sensitivity to physical flows, and a growing premium on whatever the rulebook blesses as solid backing. You can already see a small part of this on the retail side. In the last few years, many banks have cut or closed precious metals programs, especially unallocated or pooled accounts that leave them with heavy NSFR exposures. Instead, they steer clients toward fully allocated vaulted products, metal funds, or simply out into cash. For the bank, this is logical. Keeping your unallocated metal as a cheap internal liability now uses up more of their scarce stable funding, while turning it into cash removes that strain at once. For you, as a saver, it can feel like being eased out of the metal system just as the rules start to favor harder claims. This is where the issue stops being abstract. Are your metal holdings just a line on a bank screen or a claim on something that would still exist if that bank shut its doors? To see the bigger pattern, you have to look back. After the Second World War, many governments were left with debts so large they could not realistically be paid down at normal interest rates. Instead of defaulting in public, they held rates below inflation for years. Bondholders earned negative real returns. Rules and capital controls pushed banks, insurers, and pension funds into government debt, whether they liked it or not. On the surface, this was sold as careful economic management. In reality, it was financial repression, using inflation and regulation to quietly tax savers and shrink those wartime debts. In 1933, the United States banned most private gold ownership and then raised the official gold price, which was another way of devaluing the dollar. In 1971, the last formal link between the dollar and gold was cut, and the modern fiat era began. Compared with those breaks, Basel III looks dull. It is a stack of ratios, definitions, and transition periods. But the rhythm is familiar. First, something cracks in the old setup, a crisis, a buildup of debt, a loss of trust. Then the definition of what counts as safe is rewritten. Finally, capital drifts away from what used to be treated as safe and toward whatever the new rulebook blesses. Right now, that drift is toward better collateral, including fully allocated bullion, and away from the most synthetic and leveraged parts of the market. There is also a power shift running underneath. Basel rules are agreed as global standards, but each region applies them in its own way and at its own pace. Over the same years, many central banks outside the old reserve currency bloc have added steadily to their gold holdings. Some trade between countries is now settled more often in local currencies, with gold playing a quiet role in swaps and reserve deals. Basel III did not create that trend, but it fits neatly alongside it. It makes neutral collateral that does not belong to any one state more attractive on bank balance sheets, and it reduces dependence on promises written purely in a single reserve currency. In a world where trust in any one money can be dented, assets like gold matter more, and the formal rules are slowly catching up with that fact. Inside a bank, none of this feels ideological. It feels like a problem in a spreadsheet. On one side, a treasury or risk desk has to live inside ratios for stable funding, liquidity, and capital. On the other side, they can choose what to hold. They can own long loans to companies and households, government bonds that can fall in price when rates rise, or allocated bullion that uses little capital and counts as strong collateral. They are not thinking in slogans. They are thinking in basis points and balance sheet efficiency. Under Basel III, well-structured bullion holdings often score better on those internal measures than many other assets. That quiet arithmetic is what drives the shift behind the scenes. So what do you do with all of this as an individual? This is not about stock tips. It is about how you look at your place in the system. A few simple checks help. First, ask if what you own is someone else's promise. Cash in a bank account is the bank's liability. A bond is a promise from a borrower. Allocated bullion is different. It is not a promise to pay. It is just there. Second, ask what the rules reward. When new regulations give an advantage to certain kinds of collateral, money tends to drift in that direction over time. When a structure becomes more expensive to support, it usually shrinks, even if the product the customer sees looks the same. Third, ask what kind of promise you're holding. Listed funds, unallocated pools, and fully allocated bars each sit in a different place in the rulebook. The label or ticker is not the whole story. The type of claim matters just as much. You do not need to become an expert in Basel documents. But if you understand these basic differences, you are less likely to end up on the paying side of a quiet shift in wealth and more likely to at least see which way it is moving. None of this means gold or silver can only go one way. Prices can fall even if the system treats bullion as prime collateral. Regulators themselves point out that early evidence shows only limited disruption to precious metals, markets from the new funding rules. What has changed is the direction of the incentives. The large banks are being pulled away from the thinnest paper exposure and toward assets that can stand on their own in a crisis. Funding models that depend on short-term hot money are less attractive than those built on steadier backing. Step back, and this is one of the quieter ways a strained system can reset, not by a loud default, but by slowly rewarding stronger backing and letting weaker claims bear more of the strain. Savers who stay only in cash and low-yield bonds feel that through inflation and poor real returns, while institutions that shifted early into better collateral are better placed to absorb shocks. So where does this leave you? You are not writing the Basel rulebook. You do not control the funding ratios or the internal models of global banks, but you do live inside the world those rules shape. Your pension fund, your insurer, your bank, they all respond to the same signals about what counts as safe, what they can post as collateral, and how much borrowing they can run. The latest phase of Basel III is one more step away from blind faith in paper claims and toward a system that asks for more solid backing behind each promise. For you, it comes down to a fork in the road. In a world where the rulebook keeps redefining risk-free, what do you trust more, the promise or the collateral? Because when a small group of regulators decide what counts as truly safe, the big money follows their lead, whether the nightly news talks about it or not. Thank you for watching, and please subscribe. And like the video, nothing in this documentary is financial advice. Always do your own research and consult a licensed professional before making financial decisions.